Hello and welcome to BQ Prime. You're joining us on the alternative bet. Thank you so much for tuning in. We are discussing various investment opportunities that are available to investors in the alternative space. An alternative to, well, equities and bonds, which is considered to be a traditional sort of investment format. To join in this conversation with me, I have Mr. Shantanu Sahai, the Senior Managing Partner at ASK Private Credit Fund. Mr. Sahai, welcome to this conversation. I want to first talk about this private credit fund at ASK. You've announced about 1,000 crore sort of a book for this fund. What exactly are you looking to achieve through this investment portfolio?
First of all, thanks very much for having me. Pleasure to be here as well. What we are really looking to do is capitalize on the tailwinds that have been developed as a result of a slew of market forces, which have been ranging from regulatory to supply and demand to general market infrastructure. And in turn, they have given rise to a very sizable and rapidly growing opportunity within the performing credit space, which, by the way, is a subset of the private credit space.
Okay.
And what we intend to do is essentially capitalize on this opportunity to essentially generate alpha in the form of risk adjusted returns for investors who are looking to invest in the fund. We've kept a modest fund size of 1,000 crores. As you've seen, obviously, a whole number of other peers of ours before us, with us, and after us are going to be announcing similar products in the market. A number of mutual funds, private equity funds, private credit, standalone private credit funds, wealth management outfits. Everybody seems to be hopping onto this bandwagon at the moment. So fortunately, there is enough and more to play with for everyone. Of course, there will be the inevitable missteps along the way by various people. And of course, each one of them has a different forte / competitive advantage vis-a-vis each other. So I guess time will tell as to who remains standing in this jamboree at the moment. But for now, it looks like the stars are aligned in many ways to essentially create a pretty good market environment for the fund that we are essentially looking to do.
Okay, fair enough. Talking about the potential investor base that this 1,000 crore fund is looking to target, or well, any private credit fund out there in the market, who are the kind of investors who would be best suited to put their money here?
So it depends upon which part of the private credit space you're really playing in.
Okay.
If you play within performing credit, as we are, I expect that the majority of our fundraising will be with retail / HNI / family office kind of audience. As you keep moving down the credit spectrum towards semi-distressed and distressed kind of institutions, which is not where we are playing, but there are other peers in the market who are dabbling in that space, I do expect that the level of institutional participation starts to go up. Because in general, what we've seen is that appetite for loss is actually fairly minimal to zero when it comes to retail HNI kind of audience. And it tends to be a lot higher when it comes to institutional / proprietary money. And that is why the desire to play in the distressed credit space comes, whereby they have appetite for loss but are willing to take that risk in exchange for higher yields. So we expect that in our the space that we are going to play in, it will be largely a retail / HNI audience.
Okay, fair enough. And what is the level of investor sophistication that is probably needed for this? Because within the space, investor space that you're targeting, people are experts at various levels. It's not, it's not uniform, as opposed to say an institutional investor might be. So, what do you see in terms?
Well, honestly, in the space that we specifically intend to play in, I actually do not believe that there is a very significant level of sophistication that's required. In fact, I don't think there is sophistication required at all.
Okay.
Because when you think about performing credit in the simplest way, all we do is provide loans to profitable companies.
Right.
It does not take rocket science to analyze a company which is fundamentally mature and profitable at the same time. because of the simple reason that companies that are not profitable, then you have to start looking at equity value for these companies, because ultimately there is a non-zero, or well, I wouldn't even say non-zero, I would say there is a reasonable probability that you will have to rely upon some form of recovery to get your money back because the company is not performing well.
Correct.
In which case, if you are relying on equity, then you had better be sure what is the value of that equity today, as well as when the time comes to get your money back.
Correct.
In case of profitable companies, you essentially look at these companies on a going concern basis. The equity value of the company is a fallback in the event that the company is not able to perform in the manner that it has or in the manner that it is expected to.
Right.
So in that sense, our business is a lot simpler. It's a lot less reliant on equity perspectives. And as a result of that, what it also does is it is completely uncorrelated to the equity market in general. Right? When we think about investors, right? Why do investors do fixed income? Fixed income is meant to be a counterbalance to their equity portfolio.
Right.
But if the fixed income portfolio has an inherent linkage to equity value, then it's not much of a diversification anyway, right?
Correct.
Because effectively what you're doing is you are taking equity risk in some shape or form while getting paid fixed income returns,
Understood.
which is a bit of a imbalanced risk return trade-off. So in that sense, our business is a lot, by virtue of the fact that it is uncorrelated to equity in a big way, allows for true diversification away from equity, and at the same time makes it much easier, simpler, not only for us to invest, but for our investors to understand and sleep peacefully with. So the way that I would probably put it is that this is a product which is a sleep easy at night product.
Okay.
In that sense, our focus is on capital preservation. We don't mind taking a point or point and a half less on yield if we think that capital is at risk. For us, capital preservation is a priority.
Okay.
And that is the main reason why an investor should be able to sleep easy at night, simply because of the fact that they are not thinking about all the kinds of punts that we are taking with respect to companies that may or may not perform in the long run.
Okay, fair enough. Now, I want to talk a little bit about the performing credit space that you're targeting, right? One might argue that if you are looking at a better return, wouldn't a distressed or a semi-distressed make more sense than a performing space? What would you have to say to that?
Well, I don't think the investors that we are going to will want that. It's just that simple. For the same reasons that I highlighted earlier. We believe that people who are allocating money into this product want the ability to have security of their principal as their number one priority. After that comes the yield, because people think about this as a debt plus product. What used to be earlier done in the form of MLDs, what used to be done earlier in the form of simple corporate bonds is essentially getting allocated towards this business.
Correct.
And what used to be MLDs and corporate bonds used to be typically AA plus kind of paper, which means a high degree of capital preservation probabilities.
Right.
If the intention is to essentially get an allocation of funds from that bucket into our bucket, at least the credit risk component should be largely comparable, even if not completely comparable.
Understood.
And hence the need for staying within our limits from a credit spectrum perspective. If that means that we have to compromise a little bit on the yields, then that is something that we are prepared to do, simply because we do not want to risk client capital. If there are people who are keen to take that punt, whether they want to, where they are happy to take the probability of loss in exchange for 200 basis points of extra yield, they are probably better off going to either a distressed credit fund, and there are some in the market, or a venture debt fund. Again, there are enough and more in the market. This is not a product for those people who are adventurous with their money.
Understood.
That's the idea.
So people, as you said, sleep easy.
This is a sleep easy product. This is really a sleep easy product.
Okay, fair enough. I want to also talk about a little bit about the comparison that inevitably comes in, because you mentioned MLD, and MLD was a NBFC sort of controlled product. This comparison between private credit and NBFCs, what are you doing at the fund that is so very different from what a traditional lender would be doing?
So, what is an NBFC? If you think about it, an NBFC is an entity for whom capital is raw material. Right? They raise money in order to lend money. Right? And what are their assets? They are also financial assets. So if tomorrow I want to lend to an NBFC, which is what most MLDs used to do, the underlying net worth of an NBFC was essentially the loans that they had given out to various people and some kind of capital or statutory capital that was underpinning those loans, right? That is really what the capital is. A private credit fund on the other side is actually secured lending. Secured lending in the sense it is secured by hard assets. Hard assets means land, plant and machinery, receivables, intangible assets, personal guarantees, shares, whether listed or unlisted. So in other words, assets which are somewhat independently valuable apart from the business of the company. An NBFC's assets are only as valuable as the quality of its business.
Correct.
If an NBFC is giving shitty loans, the assets that it has are going to be shitty, right? If tomorrow I am lending to a company X, if that company is producing, let's say a manufacturing company or a renewables company or an auto components company, if it's producing something, there is an intrinsic value to the land that it has, to the factory that it has, even if it is producing a shitty product, or if it is producing a product at a low EBITDA margin, or if it's not being run properly. What I'm trying to say is that the value of these assets is somewhat independent and is able to retain that value regardless of how the company is performing.
Okay.
And that is the fundamental difference between an NBFC business and this business. NBFC loans by definition are all unsecured. These loans by definition are always secured. We do not do unsecured business.
Right. Fair enough. Okay, let me also talk about the promoters who would end up having to access these funds, right? So what is the kind of promoter that you're looking at? You're talking about a performing business, right? But if you are a performing business, you're a profitable business, you have other avenues for credit.
Correct.
This would even evidently be more expensive capital than, say, a bank loan would be, right?
Yeah.
Who comes to you? I mean, who do you expect comes to you?
Yeah. So I think fundamentally, there is a bit of a misunderstanding in the market that if I am a business which is lending at 15, 16, 17, 18%, the people who must be coming to me must be by definition struggling companies if they are having to borrow at that rate.
Right.
It is simply because of the fact that nobody else is willing to lend them cheaper and therefore they are coming to me to take it more expensive. I think that is a very, very significant misunderstanding in the market. Let me put it this way. Let me start with the punchline and then I will explain why I say that. The companies or situations that come to us to borrow at 16, 17, 18%, they come to us in the context of specific transactions or situations where they need that kind of money.
Okay.
In their ordinary course of business, those very same companies borrow from their banks and NBFC partners, i.e. their traditional providers of capital, at the same 9, 10, 11% that other good quality companies do.
Right.
So then the question really becomes, if a company has the ability to borrow at 9, 10, 11%, as you said, because it's profitable, because it's mid-market, because it's mature, why is it coming to us for 16, 17, 18% capital? The answer to that is very simple. In 2 words, it's called equity substitution.
Okay.
I am not trying to give money to compete against the money that they can get from a bank or an NBFC.
Okay.
I am giving money to replace the funding required in situations where the only other alternative for that company is equity. In which case, if any mid-market company in India broadly has cost of equity at 25 to 30%, if I am looking to replace that at 17, 18%, it's a significant saving for them.
Yeah.
So then the question comes, what are those situations in which the company is required to raise equity and cannot use bank and NBFC money to essentially provide that funding? 2 main growth engines in this country at the moment. 1, domestic M&A.
Okay.
Since COVID, domestic M&A has been a keystone of economic activity in India. The whole construct of a K-shaped recovery, etc., is a classic testimony to that fact. The bigger companies are essentially swallowing up smaller companies. There is consolidation going on across sectors. Now, consolidation means companies are buying other companies, in which case they are essentially buying shares of other companies. In India, there is a very clear line that banks cannot lend for acquisition of shares. There is a regulatory bar on banks.
Yeah.
In fact, it was for this very reason that the entire NBFC industry was spawned in the first place.
Correct.
2012, 13, etc. When the ILNFSs of the world and the Piramals and the Edelweiss of the world came about, they essentially came about to provide capital for situations which would replace equity simply because of the fact that banks were not allowed to lend. But with the ILNFS crisis, there was a significant pivoting away of the entire NBFC industry from wholesale lending towards retail lending.
Yeah.
It's either retail lending now, auto loans and stuff, or it's housing finance. That is what most NBFCs are doing. So as a result, the entire industry which was providing capital for domestic M&A effectively vanished. That is the blank space that funds like us essentially enter. So that's growth engine number one. Growth engine number two is the fact that in India, if you look at the last 7 years, about $150 billion of private equity capital has come in. Now, we see all private equity stories in the newspapers about buyouts that are happening, etc., etc. What is perhaps going unnoticed is that even today, 80 to 85% of all private equity capital that comes into this country comes in the form of minority investments.
Okay.
Anything from 3% to 49%. While there is a majority shareholder who is typically sitting there. Now, when all this capital came in, for all of these minority investors, what was their exit? On average, the exit used to be one of two months. One, that the company used to get sold to someone in the process, these guys used to get an out. Or two, these guys used to probably have an IPO or some kind of an offer for sale where they would tender their shares and they would get it out.
Yeah.
Since COVID, the equity market, the primary equity market has been practically, I wouldn't say shut, but highly selective when it came to companies essentially being able to raise primary capital. But when you've got a situation like this, so many companies have essentially had to either defer or call off their IPO plans, the ones who had filed DRHPs. When you've got a situation like that, and these funds have essentially been invested into these companies for 5, 6, 7 years, they are approaching the end of their investment horizon.
Okay.
They need an out, which means the only other way that is left for them is for them to go and tell their promoter, guys, buy us out. In order for the promoter to buy them out, the promoter needs money to buy shares.
Correct.
Again, the same thing. And NBFC could have lent to them earlier. It's the same logic where funds like us essentially come in. So these are the two primary growth engines which essentially allow people like us to exist.
Okay, fair enough. Coming to the private credit fund market, now there's this space that exists at this point in time. You said a lot of people have been announcing or are announcing alongside with you, or in the future will be announcing fresh funds. But you're all in this 1,000 to 2,000 crore range as a fund size. But what is the actual demand in the market at this point in time?
So I think, and this is not my number, this is a number from, if I remember right, an EY report that was released towards the beginning of this year, maybe around March or April. From their perspective, if you aggregate the two growth engines that I just spoke about, the aggregate demand per year is roughly 30,000 crores.
Okay.
And that number is growing maybe at the rate of 10-15% per annum. Now, if you think about it, that is the demand side of the equation. Let's look at the supply side of the equation. If you add all the performing credit funds that have announced or have raised money in the last 18 months, I think that number will probably be somewhere between 15 to 17,000 crore. That number is typically going to get deployed over a 1.5 to 2 year period, which is the deployment horizon for most funds. Which means that if you've got 16, 17,000 crores being deployed, it's 8,000 crores a year. So you've got 8,000 crores of supply, 30,000 crores of demand. Now, this obviously does not include the supply that is coming in from the foreign guys. The Allianzes, the Merits, the Tors, the Oak Trees, the DKs, and the Farallons of the world. They are obviously coming in with large checks as well. And that is where the supply demand is essentially being met. So if you think about it, for example, that Shapoorji deal, which everybody has obviously been speaking about, 14,300 crores, the largest structured credit deal by a wide margin ever done. And it got subscribed in a day. That's the kind of demand that you see. So there is enough and more to play with. And this kind of plays back to the first point that I made at the beginning of this conversation, which is to say that there is enough supply and enough demand at this point in time for everybody to have a say. Now, of course, people are being, the newer guys are being somewhat conservative in saying, you know, including us, that we'll probably do 1,000 crores or thereabouts. The ones who have been around in this business, who have maybe had a second fund or a third fund or at the moment, are being a lot more optimistic about it. Barings had organized a 2,500, 3,000 crore fund. Similarly for some of the others. So it just depends upon the sentiment. Now, what used to be a 400 crore number 12 months ago as being a new fund announcement is today a 1,000 to 1,500 crore number. That itself shows you how the confidence of the same players in the market. So when, if I remember right, Avendus, when they had announced their first fund, they said, you know what, 400 crores is what we will do. True North, for the longest time, never went beyond 500, 550 crores, right? Today, an Axis mutual fund has announced yesterday at 1250 crores. Right. We announced at 1,000 crores, and so on and so forth. So while anecdotally, you can, if not about these funds themselves in terms of names, but if you can see the trend line itself, people used to be a lot more modest about what they would want to achieve earlier, but now are being a lot more, well, optimistic as well as aggressive because they can see the demand out there for products like these.
Okay. I want to touch a little bit about the risk scenario here. Sure. Now, obviously, you're playing in a relatively safe, market, but we've seen situations where private credit funds have lent money to people, which have turned. Then obviously the person has defaulted, and that has turned into a bit of a scandal now.
Yeah.
When it comes to a lender and the lender's rights, or a creditor and a creditor's rights in this current market. Where does a private credit fund fit in terms of your ability to take money out in case of a default?
I think there are 2-3 parts to this. If you think about lending as a conceptual construct, there are 2 parts to a lending decision. One is the borrower's ability to pay back money. The second is the borrower's willingness to pay back money.
Yeah.
Right. In this country, despite IBC, etc., the reality of the situation is that if a borrower does not want to pay back money, you're going to be really, really hard pressed to get the money back from him. And I think that situation probably has not changed very dramatically from the times past, right? So a lending decision has to first and foremost focus upon the quality of the person that you are dealing with on the other side. And that itself is the single largest source of mortality of deals when we start evaluating our deals. Now, obviously, you tide over that by talking to people, by checking with your networks, etc. We've also got some very senior advisors onboarded onto the fund. We've got Mr. Vikram Limai, who's the ex-CEO of NSE and the previous chairman of IDFC, and Mr. Vishwanath, who's the ex-country head of TPG, as our advisors. The idea is that the presence of such people who are such well connected allows us to essentially do a market check on a fairly wide spectrum basis to essentially get a sense of how kosher is this person that we are trying to deal with. So that's one part of it. The second part of it is the ability to pay. Now, one of the things which funds had found difficult in the past was that these funds typically would lend small amounts of money. And then tomorrow, if the company were to become delinquent or struggle, there would be a committee of creditors that would get formed. That committee of creditors would have a large number of private banks, nationalized banks with 20,000-30,000 crores of money. And some fund is sitting there with another 100 crores. So nobody obviously asks for his view. And the fund in a lot of ways is essentially swept by whatever the controlling decisions on the committee of creditors is. That essentially was a learning exercise for a lot of the funds. And as a consequence of that, what we started doing was 2 things. One, we started creating bankruptcy remote structures whereby certain parts of the collateral package that we were going to do were essentially isolated from the rest of the company into a separate bucket altogether, where the funds were expected to live or die basis the value of that bucket. Again, another case in point, similar to what's been done in the Shapoorji trade. There are 3 assets which have been set aside, which is separate from all the other assets that Shapoorji has. Which is, and this 15,000 crores or 14,300 crores which they have lent is against these 3 assets, which is different from whatever 20,000-30,000 crores which is sitting in the rest of the company. The fate of lenders to this product is tied to the quality of these assets. What happens here has very little to do with what happens here. So in a lot of ways, the lenders have essentially allowed themselves to become the masters of their fate by segregating or creating bankruptcy remote ring-fenced structures, which allows them to control the quality of their assets. That's part one. The second is, even within this bucket, there needs to be a consensus on how lenders will act vis-a-vis each other should the shit hit the fan, right? And in that situation, we have started increasingly seeing what are called as intercreditor agreements, which essentially allows the lenders to act in concert, where it lays out the roles and responsibilities and the rights of each lender in a situation when things start to go wrong. I don't know if you've seen anecdotally when the Byju's situation with essentially had a problem, the intercreditor really came into play, where all the lenders were essentially acting together in concert. So it allows for certain situations, or rather it alleviates the possibility of certain situations where lenders have a different conflict of a different kind because of their other investments or other relationships with the same guy, to essentially act in a way which is contrary to the interests of the larger lender community. So these are the two ways in which lenders try, and funds like us essentially try and control, or rather have better influence over our own fates as compared to what it would have been had everybody been bunched together into one committee of creditors with one pool of collateral. These are some of the ways in which we try and control. Of course, nothing is foolproof. But at the end of the day, we can only do incremental things which allow us to have some degree of incremental control. And that's really what we are trying to do.
Okay, I want to wrap this conversation up with one question around the trend aspect of it now. Yes, it is a trend at this point in time. Private credit funds are a trend. We have seen trends before. Some of them amount to something, others sort of vanish after a brief period of conversation. What do you see as a future for PCFs?
I think this is a trend which is only going to accelerate. And the reason very simply is that the two growth engines that I spoke about, what is going to happen is that it's going to spread more and more. Private equity money continues to come at an unprecedented pace into this country. Domestic consolidation, not only is it happening, the sizes of those consolidation entities is going up. So as a result, the sizes of M&As are becoming bigger. And therefore, the need for capital on both those counts will continue to stay. Yes, the tide will ebb and flow depending upon whether there are alternative pools of capital also available to the same people to essentially meet some of these funding requirements. For example, if the equity market were to come back in a big way and become a lot more available to every type of product, some of these people would probably say, okay, you know what, let's try and raise equity rather than try and do some kind of debt, or maybe do part debt and part equity. So there may be a little bit of tempering as a result of the ebb and flow of the equity market. But personally, my view is that this is a product which is the hallmark of a maturing financial market. If you see the trends anywhere else in the world, it points to the fact that the institutionalization of private credit is something which is a fait accompli. It is going to happen in India. It is happening in India, and it has already happened in this country in the last 24 to 36 months. This market was a lot more pronounced within the leverage finance space, which the financial sponsors used to use. It has now started becoming a lot more ubiquitous within the non-sponsor community as well, i.e. the promoter community as well. And this trend is only going to accelerate. So personally, my view is that we are in for larger funds, larger ticket sizes, more funds. But yes, there will be some degree of consolidation at some point, as is always the case with any community. Some funds will stay, some funds will not. We hope to be one of those who stay. But that being said, I personally think that this is a trend which will certainly continue and accelerate as we go along.
All right, Mr. Sahai, thank you so much for joining us on this conversation.
Wonderful. Thank you for being here. Thank you for having me.